Talkopolis programming is sponsored by the following. Highland Hills, a multicultural, diversified funeral home supporting the entire Davidson County community. Visit our website at www.highlandhillsfuneralhome.com or call us at 615-650-5555.
Well, hello and welcome to Pulling Purse Strings. I'm your host, Jeremy Rettich, and I appreciate you joining us today. I have two panelists here with us, James Webb, Michael Wallin. Guys, thanks for joining us.
Thanks for having us.
Thanks for having us.
Well, today I wanted to talk about the stock market. I know a lot of folks out there with the market recently hitting a high and then coming down slightly. Some folks are concerned, depending on their age group, may have different set of concerns. But those that are near retirement are really over 50 years old. Let's start with that. What advice would you give someone that's in their 50s? They're seeing the market doing what it's doing right now. They participated possibly in the 07, 08 correction, lost 30, 40, maybe 50% or more of their money. What general advice would you give those folks? Should they be making a change? Should they consider a change? Or should they just stay the course doing what they're doing currently?
Well, for myself, when I'm talking with my clients, what I like to do is really educate them. Start with having them to understand the three phases of the financial life cycle. First phase being the accumulation phase, and that's what they've been doing basically from the ages of 18 up to retirement. But as you were stating, that client that is reaching that age 50 needs to start changing their philosophy. And a part of their philosophy is saying, should I start moving some of my money into a little safer investment strategies? We have seen a very high point in the market, historical highs today. Now, as that correction, if it occurs, does like it has done in the past, where 2008 or 2001, where we witnessed a 35 or a 57% correction, some of those people in the 50s should start taking a little safer strategy on those dollars and move into either bonds or into annuities, something that's going to safeguard and protect that asset.
One of the things I see is people seem to forget pain so easily, forget the 2008 crash. And one of the things that we're seeing is the market's at an all-time high. Now we know that we'll have another correction, as history will repeat itself. We just don't know when. So I think it's important for clients to understand the rule of insanity, which is doing the same thing over and over but expecting different results. And it is time to look at your portfolio, look at the rule of 100, do some reallocating, not having all of your money in the market. So when we do have that next crash, they're feeling the full effect of that.
Well, if you would share with everybody the rule of 100. Some folks may not be familiar with that.
The rule of 100 is very simple. You would take your age and let's say you're 70 years old. What that means is 70% of your money should be in safe accounts, and you can really only afford to have 30% of your money in equities. That way, when we do have another correction and we see that drop off, your full portfolio, that way when we do have that correction and we do have that drop, you're not going to see the full effect of the drop in your portfolio. And there's some other steps that you can take too that we employ, like using stop losses in your portfolios. I know we're very big believers on using a stop loss portfolio, something that can lessen the pain when there is a drop in the market.
No, that's great. Let's say, because I know so many folks out there, my clients, your clients, they have a 401k, and they really aren't getting professional advice on what may possibly be, other than their home, the largest asset that they have. What advice would you all give them? Obviously, if you can seek professional advice from an investment advisor, you might consider doing that. Pay them to make a recommendations on your retirement accounts. If you're unable to do that or are uncomfortable doing that, what advice would you give them for them to consider doing to their 401k, changes to their 401k, just some basic advice that might help protect them if there is that correction? Because we're at the third longest period of time in a bull market in the history of the stock market. So a correction's coming, we just, as always, we don't know when.
Well, one of the things that I would state on any investing or any financial strategies that you put in place for a client, my view is you always begin with the end in mind, taking a page from Stephen Covey. And you identify how much income, because that really is what people care about.
Absolutely.
With all the clients I've ever met, I've never had one client tell me that their desire was to own a UIT. They've never said I want to own preferred stock or a common
Mutual
stock.
fund,
They don't care where their money's invested as long as the money does for them what they want it to do. And that's ultimately create the income necessary to live the lifestyle that they choose to live during retirement. So if we begin with the end in mind, we know how much income is needed in the future, we can then back into the strategy. And speaking of the 401k, people blindly go into a 401k. Now, they may contribute up to what their business matches, but if matching is at 6%, but based on their income needs in the future was really an 8% contribution they needed to make, they're going to have a shortfall. So for every client that I work with and with our team here, I always focus on the end result, which is income back into the strategy and say, okay, do you need 8% contribution in your 401k? Do you need a 10% contribution? How much risk association needs to be inside of that to yield the return necessary to achieve the income? So in focus, it's always about the income in the future, then back into the strategies necessary. And then if you use the philosophy that James mentioned a moment ago with the stop loss, that's a hedge of protection against that correction. If that market does correct by a certain percent, it's a mechanical process, not human error involved, but mechanical algorithms that immediately gets a person out of that risk and moves them into safer money, protecting from that large drop that will occur in the market, allowing them to be able to have sustainable growth towards their income plan.
Yeah, and so let's say I'm 50 years old, and I see this all the time, 50, 60 years old, and really any age. You need to look at how much risk are you willing to take. So if you're looking and project down the road, and you want to have X amount of dollars in retirement, whatever that may be, you can back into that. How much do I need to put in per year? What percentage of a return am I going to guesstimate that I'm going to receive? And then look at how much risk you're willing to take in order to get that return. And something else I would share with our viewers is look at your statements. I mean, guys, how many times have we had people come in that are entering retirement or close to it, and they're invested like they're younger than we are, like they just started in the workforce? You need to reduce or consider reducing your equity holdings, your stocks, and move towards bonds in that 401k or that IRA plan as you get closer to retirement. And we see that too many times. They don't do that. And also something else I think that we could talk about is getting out of the way of the market. I mean, so many times, folks, I mean, there's a study out there, it's the Dow Bar Report. It's very well known. It's fairly, you might be able to look it up, Dow Bar Report. And as of 2012, over a 20-year period, they looked at how certain segments of the market performed, from real estate to equity to bonds, and also how the individual investor performed during that same period of time. And over that 20-year period, the individual investor, according to the Dow Bar, only had a 2.4% return. And a lot of that has to do with they wait too long to sell when the market is having a correction. They get out of the market, and then they wait too long to get back in. And I know in 07 and in 08 that, in 07, 08, when the market corrected and we started to see a recovery, there was, if you weren't in the market, the S&P, for example, recovered over 78% in a 10-day period. That's huge. If you didn't participate in that 10 days, that could have a dramatic effect on the performance of your portfolio. So look at how much risk you're willing to take. Log in. Don't just wait for your quarterly statements or monthly statements to come in. Log in there, and then if you see if there is a correction and you see you're at a point that you're not comfortable with how much loss that you've had, get out of the market. And then as it starts to recover, look at getting back in. But seek professional advice like myself or James or Mike Wallin or someone in your area that can help you navigate these waters. But just in general terms, James, what would you recommend with the market?
Well, if we back up a little bit, I think it's important that we educate our clients about the actual investment choices they have in their 401k. I think the biggest reason that people don't contribute to their 401k is you are in an HR meeting, you're handed a book, and you're told to fill this out and hand it back to me in the next couple of days, and you have no clue what the funds are, how it's allocated, but you're supposed to make a big decision on your retirement based off that. I know I've seen clients where their 401ks are sitting in cash because they weren't comfortable with the investment options that they have available to them. So I think it's important to get with your financial advisor. I know a lot of my clients will get with me and ask me about their 401k options. And even though I'm not compensated on that, I still give them that advice, so they're more comfortable with being able to save for retirement, know their investment options, and I can also help them if we start to see that the market's heating up some and volatility is rising. I can tell that client, hey, it's a wise decision for you to reallocate some of your funds, take it out of some of your fund options that you have, and maybe park some of it in cash.
If you're above age 60, you should also check with that HR department to see if in-service withdrawals are available.
That's a great point.
And if they are available, go ahead and take some of that money out of that 401k and have professional assistance on that portfolio, at least for that last 5 to 7 years of your accumulation period.
Share with everyone a little bit about what is an in-service withdrawal. I'm sure most viewers hear that and they have no idea what an in-service withdrawal is.
Sure, I think that's a great point. One of the things that the IRS has allowed in the Pension Protection Act of 2006 was to allow employees the ability to go in and take control of a portion of their 401k assets and be able to take that outside of the 401k plan into a rollover IRA where it can be properly managed by a money manager or an investment advisor. So that is an opportunity for the consumer to be able to go out and in that last 5 to 7 years not be hindered by the limitations of their 401k, but be able to maximize their returns through professional assistance.
That's great. That's great, Mike. So to wrap up this episode, I would encourage you to seek financial advice, professional financial advice. Don't go it alone. You shouldn't do that. It's unfortunately we don't have pension plans for most of America anymore. You are forced to take control of your financial future. So don't wait. It doesn't matter if you're 20 or you're 60 years old. Start making the right decisions today. Thank you so much for joining us today on this episode of Pulling Purse Strings.